Intercompany transfer of assets. Upstream sale of depreciable equipment. In this example, we're going to look at the consolidation accounting for the first year, which in this example is X7. We have the eliminating entries, which includes the current year activity between the parent and the sub, as well as the NCI's values and the subsidiary's equity at book value. We can now address the items of importance, which is the special allocation items that we have, which is the deferred loss and the excess depreciation. Our three-part worksheet would look something like this after EJE number 1 is posted. We've got depreciation expense on the parent's records of $15,000. The subsidiary has a loss of $52,500. We see the equipment is understated, and the depreciation is also understated as well. One of the things that we need to remember is, one, we need to reclassify items, and two, since we're going upstream, anything relating to the equity method or the other items must be allocated out between the parent and the NCI. This is the entry we made during the year to record the loss. And if you remember, that represents 80% to the parent. When it comes to the eliminating entry, we're going to do two things. The first is we're going to eliminate the income from subsidiary and the investment sub for $42,000. We're going to also assign the portion of the deferred loss to the NCI. So you add the two together, we get $52,500, which was the total loss. So 80% to the parent, 20% to the NCI. The next thing we'll do is look at the depreciation. And remember, this is the entry we made. We debited income from subsidiary, credited the investment for $6,000. And similar to before, we're going to assign the NCI their value of the excess depreciation. So we will credit income to NCI, debit NCI for the $1,500. This does two things. One, it eliminates the income from NCI, and two, it assigns the NCI the excess depreciation. We must now record the unrealized or deferred loss, as well as restate the assets and the liabilities to their correct value. Remember, the equipment is understated. The parent bought it for $105. It should be valued at $225. The subsidiary has a loss on their records, which should be eliminated. So we're going to credit the loss for $52,500. And by establishing the 120 difference to bring the equipment to $225, recording the loss, that leaves us with the accumulated depreciation amount at the time of the sale, which was $67,500. The last thing, we have eliminated any excess depreciation that needs to be taken. So what we must do now is, for consolidation purposes, we must establish the correct depreciation amount. If you remember correctly, the parent is depreciating the asset for $15,000 here. So we need to get the depreciation to its correct value. So what we're going to do is we're going to debit depreciation expense for $7,500 and credit the accumulated depreciation for $7,500. So we've got parent at $15,000, the consolidated excess amount at $7,500. That gives us a total consolidated depreciation of $22,500. And as in the downstream transaction, we're going to make this entry this year, and we'll make this entry for each and every year thereafter until the asset is eventually sold. If we recapped all the journal entries, we would have the following. And the ones that are new to us is EJE 4 and 5. And since we're allocating things to the NCI, things get a little long. So we see EJE 4 to recognize the deferred loss, EJE 5, the excess depreciation. And both of those are equity method entries that we're eliminating. And then the last is to reestablish everything. The three-part worksheet gives us, I think, a little clearer picture. We look at this, we see that we've eliminated all the items to income sub. We've established the depreciation expense to 22.5. We have eliminated the loss. We have reestablished the equipment to its correct value of 22.5. And we can see through the combination of EJE 6 and 7 that we have established accumulated depreciation to be its correct value of 22.5. We could check that. The subsidiary was depreciating the asset for 22.5 a year. So if we say X4, X5, X6, X7, it's 4 years. 22.5 times 4 is $90,000. So we've established that, a little check figure for us to reestablish the correct accumulated depreciation. As we look at consolidated net income, we see that to the subsidiary's net income, we're going to add back that unrealized loss, and then to deduct any depreciation that's related to that transaction, which we see there. And of the $147,500, we'll allocate 20% of that to the NCI. And once we've done that, that leaves 80% to the parent, or the controlling interest.